Welcome to The Explainer. Today we're tackling a financial product that tries to do two things at once: help your money grow and protect your family. And the interesting part, it's all done with a single upfront payment. So let's dive in and see how it really works. So let's start with a scenario. Imagine you've come into a lump sum of money. Maybe it's a bonus from work, an inheritance, or you've just been saving up for a while. The big question is always, what do you do with it? How can you make it grow safely for the long term, while also having that peace of mind? So what we're going to do today is break down the official brochure for LIC's single premium endowment plan. Our whole goal here is to cut through all that insurance jargon and the fine print to give you a really clear picture of how this thing works, what it promises, and who it might actually be a good fit for. All right, here's our game plan for this explainer. We'll start with the big idea, then we'll decode the jargon. After that, we'll see how the benefits actually work, look at the rules and options, get into the potential returns, and wrap it all up by figuring out if this plan might be right for you. Okay, first things first, let's get right to the heart of it. What is this plan really all about? You know, the easiest way to think about this is like it's a hybrid. It's part savings plan and part life insurance policy all rolled into one. Part of your money gets put to work to grow over time, but the other part immediately buys you a life insurance cover, giving your family a financial safety net from the get-go. Okay, you know how it is with any financial document, right? It's loaded with specific terms and jargon. So to really get what's going on here, we have to quickly decode three key phrases you're going to see all over the brochure. First up is single premium. And honestly, this one's pretty simple. It just means you make one single lump sum payment right at the very beginning. And that's it. You fund the entire policy up front, so there are no monthly or yearly payments to keep track of. It's kind of like a set it and forget it deal. Next, endowment plan. This sounds a little technical, but it's really just the official name for that hybrid savings and protection model we just talked about. It's a contract that's set up to pay out a lump sum in one of two situations. Either you make it to the end of the policy term, or if you pass away while the policy is active. And finally, we've got participating plan. Now, this is a really important detail. It means your final payout isn't totally fixed. Your policy is actually eligible to get a slice of the insurance company's profits. These are paid out as bonuses, and they can boost your total return over time. Okay, so now that we've got the lingo down, let's get to the good stuff. What are the actual benefits? What exactly gets paid out in those two big scenarios, if you survive the term or if you don't? So what's interesting here is that the payout formula is pretty similar for both situations. There's a core guaranteed amount, which they call the sum assured. That's the absolute minimum base amount you or your family will get. Then on top of that, you add any of those non-guaranteed bonuses the plan has hopefully earned over the years. It's a great illustration of how the guaranteed and the variable parts work together. All right, so beyond the big payouts, we need to get into the nuts and bolts, the fine print, right? Every plan has rules about who can join, plus some interesting options that give you a bit of flexibility. Let's take a look. So this table here lays out the basic framework, and you can see it's actually pretty flexible when it comes to age. It's open to pretty much anyone, from a 30-day-old baby all the way to a 65-year-old. You also get to pick how long you want the plan to run, anywhere from 10 to 25 years. And the minimum coverage amount, or sum assured, starts at 1 lakh rupees. Now, this is a really crucial point: liquidity. I mean, you might think a long-term plan means your money is locked away for good, but that's not exactly the case here. After just 3 months, you can actually take out a loan against the policy's value. And as you can see, the amount you can borrow actually goes up the longer you have the plan, which gives you more options down the road. You can also customize this thing a bit. You can add what they call riders for extra protection, say against accidents. And there's also a settlement option, which I think is pretty cool. Instead of getting your final payout in one giant check, you can actually choose to get it as a steady, regular income stream over 5, 10, or even 15 years. All right, now for the big question, the one everyone's probably thinking about. What kind of financial return can you actually expect? This is where we have to be super clear about separating what's guaranteed from what is definitely not. But wait, before we even glance at a single number, we have to talk about a huge disclaimer that's right there in the brochure itself. It says that any potential returns they show are just illustrations. They're based on assumed growth rates for those non-guaranteed bonuses. The real-world performance could be higher or it could be lower. It's really important to remember that. Okay, to make this real, let's just walk through the official example they give. First, check out that top row, the guaranteed benefit. That's your sum assured of 1 lakh rupees. That's the rock-solid minimum you'll get back no matter what. Now, here's where it gets interesting. In a low-growth scenario, say at 4%, the total payout could be around 202,000 rupees. But in a higher growth scenario at 8%, well, that final number would be significantly higher. And looking at it like this, on a bar chart, really makes it click, doesn't it? You've got that solid, guaranteed foundation, that's your sum assured. Then, you've got these variable, non-guaranteed bonuses layered on top. And it's those bonuses that create the potential for a much higher total return, all depending on how well the company performs. So, we've gone through the what, the how, and all the nitty-gritty details. Let's put it all together now. The big question is, based on everything we've looked at, who is this plan actually for? So let's think about this. You should probably consider this plan if you're someone who loves the idea of a simple, one-and-done investment, if you really value having a guaranteed component to your return, and you're looking for something low-risk for the long haul that combines savings and insurance. On the flip side, though, you might want to look elsewhere if you need quick access to your money, if you're chasing higher risk, higher return investments, or if you just prefer to keep your investments and your insurance in separate buckets. And that really wraps up our deep dive. We've tried to pull back the curtain on the jargon, the benefits, and the potential returns. So the only question left is the personal one, the one only you can answer. Does a single payment for long-term security fit into the financial story you're trying to build? Thanks for joining us on The Explainer.